Right. So if any more that you can come to
I
mind
think those
right
are
now?
the two biggies.
Okay. Okay, so let me throw out a couple to think about. So one is the lease. You need to find out what are the lease obligations for equipment, for the space. Now, sometimes actually you may have a favorable lease that you may actually give some value for, if it's below market lease. But the other thing is to understand, cash flow wise and so forth, what the obligations are on a regular basis related to the business. In other words, what's your monthly nut?
Right.
And I look at that. So, for example, this year I went out and bought myself a copy machine, and I said, oh darn, now I've got to pay $450 a month for this thing. So you need to be aware of what are these obligations that you're sort of accumulating. And the other is the area, of course, of, let's say, contingent liabilities.
Sure.
And that could be what are the types of return ratios and things like that. If you're selling a product and you've got a warranty or guarantee related to it, some percentage of sales is probably going to come back or may come back, and you might want to provide some sort of reserve for that. Also, of course, products liability in case there's some sort of damage that could happen related to your product and so on. So these are all things that aren't showing necessarily on a balance sheet, especially of a smaller business, because they're not necessarily as diligent related to the disclosure that's required under generally accepted accounting principles.
Another one you've probably seen at the time of the sale of a business is the accrued payroll taxes or accrued vacation pay that really often isn't booked. And if you have a reasonably large business with 100 or 200 employees, that can actually be quite a large liability on the books, and it's often not reflected properly.
Okay, that's a good point. All right. Should a business be operated differently when you're preparing to sell it? And if so, how?
Well, I think the by the book answer is, of course not. People should always operate their business in the same way. But I think one of the things that's important for a business owner who's preparing for sale is to plan for that 2 or 3 years out, if at all possible. Because it makes sense to have a good set of financial statements, a good set of books that are easily validated. And I think it makes a lot of sense, not because I'm sitting with you as a professional in the accounting business, but I think it makes sense to have financial statements that are at least reviewed and perhaps, depending on the size of the business, audited in order to make the due diligence process of the buyer much, much easier. It optimizes the chances of a successful close, optimizes the chances of value, and actually, in the review and the audit process, often the business owner learns very, very valuable things about how to operate the business that can cause it to be more profitable.
Right. So when we're talking about reviews and audits, I'll interject here that because a lot of people don't know that these are varying degrees of assurance that CPAs are providing related to the financial statements that they're associated with. And audited financial statements are, if they give you what we call a clean opinion, then that is the most assurance that a CPA firm can give. And so you can have quite a bit of a confidence usually when you have audited financial statements. Reviewed financial statements, it's not so much they haven't actually gone through, for example, an inventory observation or confirming accounts receivable. So there isn't as much actual physical documentation that happens related to review. It's more of an analytical review where basically the CPA looks at it and says, does it seem like this makes sense to me? So it's a very limited type of assurance, and a lot of people don't understand that, and it's very confusing for many users of financial statements. Okay, what or who are good candidates for suitors to purchase a business?
Well, the field is relatively limited, actually, for a privately held company. You have individuals, and fortunately in Silicon Valley, we have a large number of affluent individuals, or at least before the last couple of years, we had a lot of affluent individuals.
Market's coming back.
Yeah, it is. So individual buyers can be excellent candidates for smaller companies and often are the prime candidates for a closely held business, certainly at a retail level or a smaller individually operated business, probably going to be an individual buyer for that business. Also, of course, you've got other companies, and you've got kind of mid-sized buyers that are larger perhaps than the company that's for sale, and you also have public companies. And depending on the fit and the size of the company being acquired, a public company might be a very, very excellent candidate to be the buyer. The other group that has been most active in the market for small companies over the last 15 years or so has been private equity groups, which are pools of money that are put together by investment groups or individual investors that have put a fund together. And just as in the days of the old limited partnerships for real estate, where the entities go out and would buy apartment buildings or whatever, there are private equity groups that are organized to actually acquire, build, grow, and perhaps take public or resell privately held companies. And so those for middle market companies doing $10 to $50 million a year in revenue, have been our best sources for buyers over the last few years.
Okay, thank you for that. All right. If you're selling a business, what communication should be done for employees? I know that this actually is a concern because, of course, you're worrying about everybody running for the doors. And related to this, I guess before you answer, I'll say consult with legal counsel related to this, but why don't you take it from there?
Well, in general, and this is definitely an in general kind of a statement, in general, my recommendation for owners of businesses is that they have two choices. One choice is what I call the high road, which is a very dangerous path. But the high road is to say, I'm just going to tell everybody that the company's for sale, and then nobody will ever think that I wasn't totally above board and candid with them about what was going on with the business. Sometimes that works, but it's a very, very risky path because customers can be concerned, vendors can be concerned, employees can be concerned, and there's just a disruptive effect to it because the transfer of ownership of the business may not ever occur, or it may take a whole lot longer than anybody ever expected. In the meantime, there's the potential for a great deal of upset. So the second course of action is what I call discretion, which is to work through the process of the sale and reach a point at which you, as the owner of the company, feel confident that the sale is actually going to take place, and then make an organized introduction of the buyer to key parties to the transaction, your vendors, customers, employees, to the extent that it makes the most sense, and do that in an organized, logical way as part of the due diligence process of transfer of the company.
And again, sort of related to this, led into that before, but that there are sometimes legal requirements actually that you have to deal with, particularly when you have union employees and so forth, where you actually have to give them a certain amount of advance notice, as I understand it.
Right. And of course, the contracts that you have with customers and the landlord and vendors may require that they be notified in advance because the contracts may need to be transferred, the lease might need to be transferred, and so it depends on what the contractual obligations are with all of those parties who are involved as to when you really have to make a disclosure.
Yeah.
But in general, my experience has been that the closer that you can be to certainty that the business will transfer, the better before you begin to make disclosures.
Yeah. Okay. Do I have continuing exposure? Let's say if I was selling a business, would I have a continuing exposure to business liabilities after selling that business?
Well, I think it depends on who your attorney is.
Okay.
And how well the contract is put together for the purchase. So if the purchase agreement is done poorly, you could very well have exposure to ongoing liability